For the first time since August of 2000, mortgage rates skyrocketed to 8% on Wednesday morning, according to the Mortgage News Daily. This milestone comes as a yield on the 10-year U.S. Treasury bond surged to the highest level since mid-2007 today. Due to the sharp rise in rates, applications for home loans nosedived to multi-decade lows last week as home buyers are looking for more creative ways to buy a house with a more affordable payment. What could possibly go wrong? So in today's video, I'm going to share all the details. And of course, if you guys are new here, I invite you to subscribe to this channel right now. Help me get to 100,000 subscribers by year end because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house based on the latest data we have today. So of course, thank you so much for doing that. I appreciate you. And let's begin today's video. This is just absolutely crazy. This is on Wednesday, October 18th. The yield on the 10-year U.S. Treasury bond increased to 4.887%, a 4 basis point increase compared to yesterday. And this, by the way, is a video I'm making right now at 2:29 p.m. Eastern Standard Time. With a quick Google search of mortgage rates today, for people with a FICO score of 740 to 759, which by the way, you get the best rate if your FICO score is over 740. Google here is saying the average rate is at 8.48% for a 30-year fix. Also, according to Investopedia.com, as of today, the 18th, it surged to 8.45%, just absolutely crazy. These are rates for people with great credit, buying a primary residence, not buying an investment property, and putting down at least 20% in order to buy a house. Or if they're refinancing, they have at least 20% equity in their houses. But 8.45%, just absolutely crazy. Also, according to the Mortgage News Daily, as of today, the daily rate is at 8% flat. A jumbo rate, it's at 8.06%, and FHA and VA loans are around 7.40%. When looking at daily rates for a 30-year fix 1 year ago, we were looking at a rate at 7.15%. So therefore, daily rates have increased by about 85 basis points or 0.85 percentage points compared to 12 months ago. Also, when looking at the past 20 plus years, we haven't seen rates above 8% since August 11th of 2000, when rates were at 8.04%. That's according to the weekly rate, according to Freddie Mac. Now, here's something I also noticed as well today. This is the CME FedWatch tool. This provides the possibilities of future rate hikes and decreases by the Fed based on their upcoming FOMC meetings. Their next meeting is in 13 days from today, which is on November 1st. So the likelihood of a pause by the Fed in their next meeting about 2 weeks from now is at 97.2%. The current range for the federal funds rate is at 5.25% to 5.5%, the current rate that the Fed sets. And of course, the federal funds rate is the overnight rate that banks charge each other to lend money to each other here, not the rate that home buyers are using to buy houses. That's mortgage rates. But this is an indirect relationship regarding mortgage rates. So the probability right now of a pause by the Fed is at 97%. Yesterday, it was 88%. Interesting here as well, because I made a video about this yesterday. The probability of a rate hike by 25 basis points from 5.5 to 5.75% is now only at 2.8%. Yesterday, it was at 11.5%. Let's have a look at December 13th, their last meeting this year though. Some changes though. So again, a probability or a strong probability that the Fed will pause by a 61.1% chance here, but a 36.8% probability that the Fed will increase rates by 25 basis points. Yesterday, that probability was at 38.5%. 1 week ago, though, it was at 26.3%. Then in 2024, they're not looking at any rate hikes. In fact, we're really looking at when is the Fed going to start decreasing rates or do a Fed pivot is what people call it. You have to go until July 31st, 2024 to get to a higher chance of a Fed decrease by 25 basis points down to 5.25%. That's a 34.2% chance versus a 28.1% chance that we're going to still be at 5.5%. So big picture here, we're going to see the federal funds rate be higher than what was previously expected, which of course will impact our housing market, of course, mortgage rates as well. So speaking of rates, it's just absolutely crazy. Look at this. Just posted today, October 18th. This is from the MBA. It says applications for mortgages decreased 6.9% compared to the previous week. And this is for the week ended October 13th. So total applications, of course, includes refis plus purchases. People doing refis in order to refinance their mortgages. And of course, people looking to get a loan to buy a house. So they're applying for those types of loans. So the refi index decreased a whopping 10% compared to 1 week ago. And also it's down by 12% from the same time frame 1 year ago. Meanwhile, the seasonally adjusted purchase index, a measure of the amount of people submitting loan applications to buy houses, fell 6% from last week. And it's also down by 21% from the same time frame 1 year ago. Also, based on my own analysis of their purchase index is now at the lowest levels we've seen going back to February of 1995. So can you see a huge pullback in home buying demand because of these high rates and of course, high home prices as well, because prices haven't really decreased very much. We are seeing a seasonal decrease in prices, but they have not decreased the same rate we saw back in the last half of last year. So speaking of their purchase index, here is a chart over the past 5 years here. As you can see here, applications for home loans have been falling ever since really the early parts of 2021, especially in February last year. Applications really fell off a map here, or fell off a cliff here. And the reason for that is this right here. The orange line right here is the average weekly rate for a 30-year fix according to the MBA. Ever since the early parts of 2022, rates have been absolutely skyrocketing. And now the current levels are the highest levels since August of 2000, which of course is one of the main reasons why purchase applications have been falling greatly. Again, the lowest levels going back to 1995. All right, let's get back to the MBA's report here, because according to Joel Kahn, who is their deputy chief economist, he stated the following. So total applications, which includes refis plus purchases, decreased to the lowest level since 1995 as a 30-year fixed mortgage rate increased for the sixth consecutive week to 7.70%, the highest level since November of 2000. That's based on a weekly rate last week, according to the MBA. But as I shared with you guys, according to Google, we're at 8.5% today, which is October 18th. Investopedia.com, 8.45%, and the Mortgage News Daily at 8%. So the application numbers next week will likely look a lot worse because rates have been spiking this week here. In regards to home buyers getting more creative, which is a light term I'm using here, the adjustable rate mortgage share increased to 9.3%. So of all the applications for home loans, the share of those was at 9.3%. So more or less 1 in every 10 applications for home loans was for an adjustable rate mortgage. In my personal opinion, a risky loan product, especially compared to a 30-year fix, because an adjustable rate mortgage, of course, is fixed for a very short period of time. Maybe it's 3, 5, 7 years, compared to a 30-year fix, which is obviously fixed for 30 years, not for a short period of time. In any case, the share of ARMs was at 9.3%, the highest share in about 11 months, as some borrowers look for alternative ways to lower their monthly housing payments. So why are they doing this? This is because rates have been increasing greatly, and because the rate on a 5/1 ARM, for example, is a lot lower compared to a 30-year fix. So according to the MBA here, for conforming loan balances, this is loan balances less than $726,000. is at 7.70%, up from 7.67% 1 week ago. But for a 5/1 arm, you're looking at a rate at 6.52%, about 1.2 percentage points less than a conforming loan balance at 7.70%. As I mentioned in previous videos though, this 9.3% share right now is below the high we saw last year. I believe the high last year was around 12%. The low was around 3%, but still very much at elevated levels because the spread between a regular 30-year fixed rate loan compared to a 5/1 arm, for example, has been actually growing. Therefore, people are looking for using an adjustable rate mortgage in order to buy a house, which in my opinion is very risky. Let's move on though. Let's look at another leading indicator of home buying demand here. Here is the number of real estate showings across North America, according to showingtime.com. By the way, all the articles I share in my videos, including today's video, I provide a link in the video description below. I provide all the links in the reports I share. So if you guys want to look at these reports yourself, feel free to do so here. Anyways, for the week ended September 29th, the number of real estate showings compared to the first week this year is down 9.7%. At this time last year, we were down by 23.6% compared to the first week of 2022. And in 2021, we were up by 7.3%. Again, a friendly reminder though, this is based on the first week each and every year. In 2022, the first week of 2022, I should say, real estate activity was still fairly strong because we had all-time or near all-time record lows for rates back in August of 2021. Therefore, real estate showings was still fairly strong in the first half or the first week of 2022. This is much different compared to the first week this year though, because we're coming off one of the biggest corrections in our US housing market we've had in quite some time. So real estate showings in the first week this year was a lot lower compared to the first week of 2022. So this is not really comparing apples to apples, just comparing the number of showings compared to the first week each year. Anyways, let's move on here. Let's have a look at the number of people searching for homes for sale on Google, another loose indication of home buying demand here. So according to Google Trends here, the index right now is at 73. 1 year ago at this time, it was at 78. So the number of people searching for homes for sale on Google is slightly less than 12 months ago, but still at very low levels. With that said, please comment below with your biggest takeaways from today's video. My biggest takeaway is this right here. I just can't believe that the Mortgage News Daily is reporting average rates, again, for people with great credit, paying no points whatsoever. We're at 8%, well above the highs we saw yesterday. So for example, yesterday, which was October 17th, we're at 7.92%. Now it's at 8%. Now here's something crazy as well, because over the past 3 business days, daily rates went from 7.66% to 8%. That's an increase of 34 basis points over the past 3 days alone. If these rates sustain at these levels here, we're going to have a housing market crash, even worse regarding home sales, not prices just yet because inventory levels are still historically low, but home sales are going to absolutely plummet if we have these high rates sustain at these sky high levels. Anyways, can't get over today's video here. Anyways, I appreciate you guys watching today's video. Thank you so much for supporting the channel. Like and subscribe. And of course, share this video on your social media. Hope you have an awesome day and look forward to seeing you on the next video.